What's up, guys and girls? Welcome back to another week of Mind Over Markets. These are what I like to call these sessions. They are primarily what we focus on as part of these bi-weekly performance and psychology catch-ups. If you are here, if you're tuning in and watching this live, make sure you come and say hello in the chat. I will be keeping an eye on the conversation out throughout the space of today. So if you guys do have questions, if you have feedback, anything that you want to throw into the mix throughout the space of today, make sure you come and say hello. And as well as towards the end of the session, I will leave a few minutes. If you guys want to do a little bit of open Q&A, I'm open to taking any questions that come this way, and we'll try and give you my best to give you some feedback. Now, for today's session, as I mentioned, these are a mixture of a session to improve your performance, but also a session to kind of deeper understand your psychology. It was always my biggest hurdle, and it's the thing that I like to help, to coach, to advise other traders on, to give you some legwork into making some progress in the direction that you want to head in. Every single one of these sessions is with a view to improving your performance in some way, shape, or form. And that's the aim, it's the purpose, and everything that we're aiming to achieve is all about ultimately consistency. Consistency, your approach, and I believe that consistency is what's going to lead you to have a more consistent return from the markets. Doesn't necessarily mean daily, weekly, maybe monthly. And I specifically mentioned that because of today's topic, which I'll get into very, very shortly. But it guarantees, or at least improves the probability that over a larger sample size of time, you're more likely to do well rather than give your money away, right? Now, today, as always, I want to talk about a very, very important topic, but specifically for what we're doing here as part of the Darwinex community, I think this one is very, very fitting if you're trying to find success in this game. Because what we're doing here specifically is really trying to breed professionals. We're trying to breed a wave of traders that can really manage a portfolio over time and stand the test of time regardless of market conditions. Now, as many of you, I'm sure, will be aware, the market is going to throw anything and everything at you, right? I hold a philosophy much I took from my early years of having certain experiences and really going through things like trading in the zone and understanding that in an uncertain environment, anything can happen at any time. I think Friday was a prime example of this, right? For those of you that are relatively new to the game, for those of you that don't have this much experience, these events do occur. Now, whether they're warranted or not, they are things that you have to be prepared for, both strategically and psychologically, if you want to be able to survive in the long run. Now, I've mentioned in some of my previous sessions, I've been at this game for over a decade now, right? It doesn't make me the best trader in the world. I'm not going to sit here and tell you I've got it all figured out and I'm an absolute wizard on the charts. But there is one lesson that has constantly been hammered into me over the last decade in this game. And it's something I actually tweeted about the other day because I think it's such a true reflection of everything that we do. And again, it's going to make a core part of what we are focusing on today. And that lesson has always been to really be successful at this game, whether you consider yourself a trader or a more longer term investor. This game is always about not necessarily how much money you make, but how much money can you actually keep, right? It's not about how much money you make. It's more so about how much money you can actually keep. And again, for those of you that are keeping up to date with everything that's going on inside of the markets, Friday was a true testament to that, right? Especially if you look at things like the crypto space, the amount of people that were liquidated in that space because of the amount of leverage that they're using in some of their positions. It's a true test to really understanding how important it is that you can survive in this game. I think everybody comes into this game with a mindset of, I need to make money. I need to compound my account. I need to do whatever it takes so that I can go on my dream holiday or buy my sports car as quickly as I possibly can. But what most people ignore is the idea that you have to be able to understand that it is your ability to manage risk. It's your sustainability over time that really determines your success. And that is why I think today, and specifically today, after the events of Friday, is a very fitting time to talk about the idea of how do you survive drawdown. Because the reality is, it's guaranteed for each and every one of us. I don't care whether you're the best trader in the world or whether you have a very subpar strategy. Drawdown is absolutely guaranteed for each and every one of us. And for those of you that are very, very new to this game and maybe unfamiliar with the term drawdown, drawdown is the term that we use to describe a decline in value from your equity from its peak right the way down to its trough, right? So I'm sure, as many of you will know, your equity curve doesn't move up and to the right all of the time. You're going to take losses. You're going to go through periods of losses. And those periods of decline are what we like to call drawdown. Now, the reason it's so important that we cover this today is because, as I mentioned, it's absolutely inevitable. The problem that most traders have is they haven't really accepted and anticipated and prepared for the idea that drawdown is going to happen to them. And this was a flawed assumption that I most definitely had very early into my career as a trader. And it was this flawed idea that at some point in time, I will be able to do something or learn something or be able to analyze the market in a certain way that prevents me from experiencing this. And whether I knew that subconsciously or subconsciously, that was definitely the approach that I took. Because without a shadow of a doubt, whether it was during a small period of drawdown or whether it was a losing trade, a losing week, a losing month, it took very little for me to chop and change my strategy to something new, presuming that whatever I was doing was broken. And it's because I took every loss personally. It's because I took every losing streak and every period of drawdown like it was personal, like it was a reflection of my true performance and like it was part of my identity. And the reality is, and the thing that took me the longest time to really experience and take on board, was that drawdown is not personal. It's statistical. Every strategy, no matter who you look up to, no matter how good the strategy, it's going to go through a statistical period of drawdown. And the key for me to determining success is actually not what happens at the highs, it's how the system fares during the lows. Because let's be honest here, if you're someone, especially if you're someone that trades mechanically, if you're the person that sits there and clicks buy or sell, it's really your mindset during those low periods that often determines how successful you're going to be. It's easy to do everything right when you're making money. It's easy to be consistent when the market is agreeing with what you're saying. But if you're going through a period of time where you're analyzing the market, you're making calls, and not just you've taken one loss, but you've taken 2, 3, 4, 5, 6, 7 in a row, how strong is your psychology? How much do you actually believe in your edge in the market? How consistent can you be in showing up tomorrow to do the exact same thing that has lost you money for the last handful of trades going back? Because that's the reality of this game, right? So something that I always focus on, and I look at this a lot when I look at people inside Darwinex, and I'm looking at people's Darwins, and really the thing that I'm looking for is how do people cope with the lows? Because there are many of you that have a pretty solid and substantial performance over a period of time. But the thing that I'm always looking to kind of really analyze performance is what happens after a period of drawdown. And in my opinion, a healthy approach to the market and someone that you should be trusting in the market is someone that has been through that decline, has been through that period of drawdown, and actually you've been able to see them manage risk, keep their cool, be confident in their approach, and be able to recover and return to new equity highs. That is the robustness that I want to see, not just in the strategy, but in the individual that is applying the strategy, because that's an equally important measure. And this is why I think today's topic is very, very fitting for the idea of having long-term success in this game. You can have back-to-back months of 2%, 5%, 10% returns if you really wanted to, right? And I'm sure probably there are some of you that have had a performance like that. But the truest test is what happens when it doesn't go to plan. What happens when you have the best of intentions, you do everything right from your end, but the market seems to do nothing except just want to slap you in the face time and time again. And I say it as raw and as honest as that, because honestly, after a certain string of losses, it can certainly start to feel that way. If you don't have the ability to survive drawdown, your days in this game are numbered. And again, Friday was a true testament to this, right? Friday, we really saw where the tide went back out And we figured out how many people don't really have the right gear, the right equipment to really survive when it really counts. We saw how many people were really overexposed and really did not have an idea of how to manage risk. It is moments like Friday which are going to teach you the hard way in order to manage risk over time. And this was something that I was very fortunate enough to learn early on, right? Something that I would have spoken about very early into our sessions together is there was a day for me that truly left an imprint on my psychology, right? And that day, from memory, we're going January the 15th, 2015. And it was the day the Swiss National Bank removed the peg between the Swiss franc and the euro. And the markets absolutely tanked. And for me, that day, I personally got to witness not just traders lose everything, but I saw brokers go under. And that was a day where I was humbled by the market. Thankfully, I wasn't in a position. I didn't actually have any negative impact off of that event, but I know many and observed many that did. And it was a very, very humbling experience. And it really gave you a newfound respect for the market to understand that truly this idea of anything can happen at any time, it truly does exist. If you're not prepared for those moments, if you don't really know how to manage risk when things are not going your way, you're not going to have that ability to survive in the long run. And that's something that you need to keep on board. Okay. Couple comments in the chat. Corolla says, hello. Hello, Corolla. Thank you so much for tuning in. Ignacio says, my Darwin is HBZJ. Can you analyze it? How do you see it? Ignacio, we are going to see if maybe we can come back to this towards the end. Otherwise, I'll see if I can speak to the Darwinex team to see if maybe we can put up sessions specifically like this, where we take a break from the educational side of things and we actually go through your guys' performance and we do some dedicated sessions around this. So leave this with me. I will get back to you. If not by the end of the session, then we will be covering this at some point in the future. Now, back onto today's topic, right? The idea of surviving drawdown in and of itself. Let's firstly, before we talk about some strategic ways in how you want to be doing this and things that you want to be thinking about during this time, I firstly want to start with the mindset, the psychology, and I want to talk about actually why it's so difficult. Because I think gaining clarity on understanding why we all struggle with it is actually going to provide you a cleaner and more direct path to figuring out how you can actually survive it. Because you're going to start to understand some of the common mistakes and traps that many people fall into. And often they are not our fault. Not our fault in the sense that it's not a you flaw. It's a human thing, right? The way we respond to certain situations and for how the human mind is wired, it's a good reflection as to why so many traders struggle to survive in this game in the long run and why we struggle to make money. Because ultimately, for the vast majority of us, and this brings me on to the first reason that I want to cover today, the human mind is not wired for performance. It's not wired to help you to thrive in a probabilistic environment. And this is one of the biggest reasons why trading is so hard. The human mind is largely wired to operate in a very linear way, right? We are often taught and we accept ideas that operate in a very linear way. A plus B often equals C. 1 plus 2 equals 3, right? We want to know that if a certain input goes in, a certain output comes out. There was a very infamous quote by, I believe it was Einstein, who said the definition of insanity is doing the same thing over and over again and expecting a different result. Think about that in the context of trading for a second, because it really doesn't apply, right? In trading, you're expected to have a fairly consistent approach to the markets, but you're expected to anticipate that today I might do it and I could make money, and tomorrow I could do it and I may actually lose money. And this is something that we all have to accept, as this is how the industry works as traders. There's no amount of knowledge, analysis, connections in the market that is ever going to negate that, right? There is a certain degree of uncertainty in the market which we have to accept. And really this comes back to one thing, and that is our belief system, right? Our belief system about how we how we thrive in the markets over time is something that we all need to be prepared for, right? Because ultimately, and from what I've shared already in this session, the human mind is not wired for survival, right? Sorry, the human mind is not wired for performance. The human mind is wired for survival. And that's what we have to be taking on board as traders. Every decision that we are largely making, whether it's to do with the markets or in everyday life, we are really choosing to prioritize the fact that we are moving away from pain and we are moving towards a certain level of safety, comfort, right? We're getting rid of discomfort. And this is often why staying in our comfort zone is very, very easy. This is often why we do things in certain ways that are purposefully trying to avoid pain. And that's something that we have to be mindful of, right? If you've been brought up in any way, shape, or form where you are wired to believe that losses equal failure and failure doesn't allow you to succeed, because this is what, let's be honest, the modern day schooling system teaches us, right? You have to get good grades in order to get into the class that you want, in order to be able to take certain, lessons or study certain subjects in order to be able to get the job that you want, in order to really be able to succeed. And so you're taught from a very early age that if I want to do well, if I want to be a success in life, I have to be able to be correct and I have to be able to do things correctly. I have to do well in my exams. In trading, it doesn't really work that way, right? Depending on how you manage risk, you could be in a position where you might only win 2, 3, maybe 4 trades out of 10, but you can still make money in this game. So actually in this game, and I think as the person that put it most poetically was Tom Hugot, right? In this game, it's really all about understanding that it's the best loser that wins. And one of the reasons that most traders struggle and they fail to find success in this game is that most of us have a belief system that is wired to avoid failure, right? We're wired to avoid losing. This is why we generally revenge trade, we overtrade, we jump back into the market, we get angry with losses, because we are wired to believe that if the market tells us we are wrong, it hinders our ability to actually succeed over time. When in this game, that's not necessarily true. So we have to be able to flip that mentality. We have to understand that most of us as human beings, we have a belief system that doesn't cope well with losing. And so the problem for most people is not necessarily that you've taken a loss or that you're going through a string of losses. The problem for most people is actually that you haven't been taught how to lose. And this is something that you really need to be aware of. Okay. So the human mind is wired for performance. It's wired for survival and not necessarily for performance. And this is something that we all have to be keeping in mind. Now, I want to add on to this and build onto this layer, because I always say that beliefs are the root and the heart of everything that we are doing, right? Beliefs make up everything that we have going forward. Beliefs create our thoughts influence our emotions, emotions change our actions, the actions that we repeat become habits, and habits are essentially part of our identity. So if beliefs are the foundation of everything, our thought process on top is something that we also need to be mindful of as well, because as we know, it plays a very important part of how we act on a day-to-day basis. Now, from a psychological standpoint, in terms of the thoughts that we have on a day-to-day and week-by-week basis, we have to understand that we are subject to various cognitive biases, right? And these are flaws in our interpretation or our perception of the outside world, and they bring us to answers and conclusions which don't necessarily represent everyday life. Now, the one that you'll hear me talk about a lot during this session and in many of the sessions that we have going forward is actually the idea of recency bias, right? Recency bias, for those of you that are unaware of it, it is the natural human tendency for most of us to be swayed by and put more importance on recent events as opposed to what may actually happen over time. And this is going to cloud your judgment. And this doesn't happen specifically just in trading. It happens in every area of life. If you were in a relationship and your partner cheated on you, it's likely that when you get into your next relationship, you're going to have some trust issues, right? You're going to be a little bit on the defensive side because of what you've experienced. If, God forbid, you were in a car accident, right? You may have been driving 1, 2, 5, 10 years, but you got into a car accident. It's very, very likely the next time you got back into the car, you're going to be a little bit more wary. You're going to double check each time you take a turn. You're going to be a little bit more heavy on the brakes. Why? Because your mind is telling you that after this recent experience, you need to be able to protect yourself. It goes back to that survival mechanism, right? Now, in the context of trading, think about how this applies. The human mind is constantly prioritizing things which have happened in the short term, which generally lead to what you experience and how you think about the markets in the long run, right? We are swayed by recent events. And that means if you have a losing trade, you're far more likely to be doubtful of your strategy in the long run. And if you have a winning trade, you're far more likely to be confident or overconfident to a certain degree. And this is something that you want to be keeping in mind. So in the context of what we're talking about today, which is surviving a period of drawdown, this is really, really important to understand. The human mind in its raw form for the vast majority of us is going to work in a way that prioritizes and puts more emphasis on recent experiences. So if you're someone that's going through a period of drawdown, it can start to feel very, very heavy. It can start to feel like your strategy is broken. It can start to feel like you need to be doing something different if you want to be getting different results, because this is what every aspect of life has taught you. And it's something that once you become very, very conscious of, you can start being aware of this pattern of behavior, right? And to give you a very real and raw and honest example, the last 2 weeks that I've been trading, I've had back-to-back losing weeks. And it's so easy to understand that, or it's so easy to feel in this moment that something's broken, something doesn't work so well. And the thing that I'm constantly reminding myself of is when I get to the end of a week, I'm updating my journal and I'm looking back over my data and I'm trying to remind myself that 2 weeks is a meaningless sample size, right? 2 weeks means absolutely nothing in the grand scheme of things, because the likelihood is for the vast majority of you, unless you're a very, very short-term scalper and you're taking numerous trades per day, the likelihood is you don't really have a good sample size of trades to determine whether something has really changed with the performance of your edge. But secondly, it also doesn't take into an account that maybe the market conditions over the last couple of weeks maybe just don't align with your edge. And so instead of me sitting here and saying my strategy is broken and I need to learn something new and I need to change my approach in the long run, I have to sit down and say, well, what is actually likely to occur if I stay consistent with this approach? Am I actually more likely to make money? Have I been through periods like this before? And this is me actively doing things to start to counteract this recency bias, to help me to understand that my mind is naturally going to prioritize these things in the short term. But in the long term and the grand scheme of things, we actually have to focus on what happens over both a large sample size of trades and time, right? When you focus on both of those things, you start to eliminate and find probability in the long run instead of randomness in the short term. And you start to focus on market conditions that are not going to be somewhat erratic in the short term. And, they are going to be in your best interest at finding probability in the long run. If you were to only judge your performance in the markets over 1, 2, a handful of days of trading, how likely are you going to be to actually find an edge in the long run? If you only judge the performance of your portfolio or your trades over days like Friday, for example, do you think that's going to be a true indication of what market conditions are like as to whether your strategy actually works over time? It's not. It's going to give you a flawed perception. And this is why a trader's secret weapon is really your ability to think and play in a way that allows you to prioritize the long term. The problem is most traders either don't have an edge to begin with, and they're fooling themselves into believing that they do. Or secondly, they're managing risk in a way, or they're not being consistent enough in a way that allows their edge to play out over time. Those are the only real two reasons why you're not going to be making money in the long run, right? It sounds very simplistic, and it obviously can be very difficult to make sure you're sticking with those 2 points. But it's that simple when you simplify how you make money in this game. You need to have an edge in the market, and then you need to be consistent with applying it, both in terms of your actions and how you manage risk over time to really allow that edge to play out in the long run. Okay. So your belief system makes this difficult because most of us are wired to think in a way which doesn't allow us to thrive in the long run. And then secondly, we have these cognitive biases like recency bias, which make us believe that our recent performance is indicative of what is likely to occur in the long run, which is not a true reflection of what this game is really about, right? The last two things from a psychological perspective which really make this difficult for most people. And this is where we start getting up to the surface level issues that most people focus on, but are not really responsible for what's going on that's driving their thought process, is firstly our ego, right? Many of us bring ego into this game, and we attach our self-worth or our perceived performance to our P&L, right? If you only feel good about your performance when your P&L is going up, you're setting yourself up to be on this roller coaster of emotions, which is less likely to make you consistent in the long run, right? You have to remember that your ego has to be left at the door with this game, because trust me on this one, the market is going to humble you. It doesn't matter who you are, how much experience you have. There are going to be periods of time that you have to be able to understand the market is just not going to be in your favor. You could have all the best analysis in the world. You could have every fundamental and technical factor aligning with your thesis. But really and truly, the moment you hit buy or sell, you've basically relinquished all control. Because what happens after that point is up to the gods of probability. And they, at least from how we've been seen or what experience has shown us over the last few months and years, is that in this day and age, it could just take one tweet or post from Trump to really send the markets into chaos and invalidate any idea, at least in the short term, that you may have had for the markets. So bringing your ego into this game is really, really pointless, right? Bringing your ego into this game is something that has to be left at the door. And you have to remember that your ability to perform is not closely correlated with P&L, right? Because there are going to be guaranteed periods of time where you don't perform to the level that you would like or you would hope, but it doesn't necessarily mean that your strategy is broken. It doesn't mean you're doing anything wrong necessarily. It's just a statistical part of this game, right? The last one, and I think it's an important one to talk about, especially in this day and age, it is our attachment to money. There are going to be some or many of you watching this live or maybe watching this back on a recording that have the hopes and desires to one day become a full-time trader. And when I say full-time trader, I'm talking about someone that makes their sole living from the markets, right? No other forms of income apart from the money they make trading and or investing. Now, I'm not saying this is impossible, but at least from my experience, what I tend to find is when you need the next trade to win, when you're hoping that it's going to pay for some aspect of your life, it makes your ability to think clearly that much more difficult, right? The need for the market to do something really hinders your ability to have clarity of mind. And this is something that's always going to work against you as part of everything that you do in this game. And so I always encourage, it's one of my most popular opinions that I always share. I always encourage that if you're an aspiring trader and or investor, it makes sense to have multiple sources of income. For me, it doesn't make sense to have your sole income coming from just one place. And this is why I always believe that I think most people would actually be better off if they viewed trading and investing much like a side hustle, right? I'm not saying it's impossible to be successful as a full-time trader with only just your money coming just from the markets. All I'm saying is it's infinitely more difficult. And your odds of success in terms of consistency, in terms of mental clarity, in terms of being able to manage risk, they are infinitely improved the moment you don't need the markets to do anything, right? It's easier to go through a period of drawdown and not make money today, this week, this month, this quarter, if you know that you don't have any expectation of the market. If the market doesn't need to pay you today in order for you to make your living, this is something that you want to be keeping in mind, right? And some of the best traders, right? The ones that maybe you think about and maybe you aspire to be in a position of at some way, shape or form, whether that's, investment banker, whether that's, trading at an investment bank, or whether it's trading for a hedge fund in some way, shape or form, they are all paid a salary, right? They may get performance bonuses on top, which really help their overall bottom line, but they are all paid a salary. Their bills are taken care of by what they do in the markets. And in some cases, those are pretty substantial salaries for what they do, right? Think about that for a second. The people that are doing this really at the top of their game and are probably managing amounts of money that we could only dream of, They're all paid a salary for what they do. It has a huge impact on your mentality. And so as a retail trader, for someone that is doing this for themselves, your attachment to money is something that you need to be very, very mindful of. If you're someone that's approaching the markets and you need the next trade to win, psychologically, you've already lost, because there's only so many times that can work against you before it starts getting the better of you. And that's something that you really want to be taking on board. Okay. So how do you actually fix this? How do you put yourself in a position whereby you are giving yourself the best odds of actually succeeding in this game and being able to not just experience drawdown, but make it out the other side? The first thing I would say, and the first thing that I think needs to be fixed, is really your expectations, right? I think most people fail to deal with a period of drawdown in a productive way because their expectations around them are so flawed to begin with, right? The best advice that I ever heard and I took on board, and it's something that I carry with me day in and day out in the markets, is to remind myself that this game is not about winning versus losing. It's not right or wrong. It's really about how much money will you make when you're right versus how much money will you lose when you're wrong. Because let's be honest, becoming profitable there's no secret sauce. There's no one strategy, which is, some secret holy grail, which works for absolutely everyone. If you've done any degree of education or research into the markets and you've read anything like, for example, Market Wizards, it should show you that there are people that are trading a variety of different ways with various different belief systems about the markets, but they all make money in different ways, right? That should show you that there is no one way to actually excel in this game over time. You have to understand that finding success in this game is really just a game of math. That's all it comes down to. It doesn't matter how you trade. It doesn't matter what strategy you use. It doesn't matter how you go about applying risk and deploying capital into the market. Becoming profitable is really just a game of math. And a profitable strategy is going to do either both or one of two things. It's either going to win more than it loses, or your winners are going to outweigh your losers, right? Because in any way, shape, or form, win rate and risk to reward are two factors that have to be spoken about in the same sentence. Win rate is not the most important thing, and neither is risk to reward. There are plenty of traders that could have a high win rate but could still be losing money because their risk management is not great. There are plenty of traders that could have a win rate below 50%, but they still could be wildly profitable or could be losing money depending on their risk to reward on each of their trades. And so finding profitability is really just a balance between finding the right win rate and the correct risk to reward that balances out, that you can be consistent with, that allows you to be profitable over time. But most people forget this. Most people focus on the idea and they get caught up in this game of thinking, I need to win every trade. It's not about winning versus losing. It's a game of risk management. It's all about how much you make when you're right versus how much do you lose when you're wrong. And if you can get that balance correct between your win rate and the risk to reward that you gain on each trade, you can find profitability. It's just a game of math. So align those expectations to begin with, because if you could do that from the very, very beginning, then accepting losses becomes infinitely easier, and therefore surviving a period of drawdown is equally as easy to come out of. Okay. The second thing that I see people do wrong when it comes to expectations is actually to do with the data or the back testing that they have done in particular. I have seen many traders that go through a period of back testing or data collection, and they say, well, actually, my strategy over the last X amount of trades, it produces an 80% win rate. And what we tend to see when you actually start breaking down what they're doing in their back testing, especially if they have somewhat of a mechanical approach, is you see them actually trying to fit the trades with the opportunities that are setting up, right? They don't have a true reflection of how their strategy performs over time. They are simply trying to fit and only find the profitable trades that work over time. They are ignoring certain bits of data. They're ignoring, certain periods of time where their strategy doesn't work so well. And so what I would say is, if you're serious about collecting data, if you can program it and have it coded to run in a fairly mechanical way that takes the discretion out of it, that's going to give you the truest reflection of how your system performs over time, right? If you're someone that's manually testing, you need to be aware of this idea that your mind is going to want to get you to eliminate situations which don't go your way. And so what I would argue is that as part of your back testing and your data collection, yes, you want a strategy and approach that most definitely yields a profitable return. But equally, you want to make sure that losses are included as part of this sample size, and that you make sure that they are controlled losses, they fit in line with your plan, and that your system actually does recover from them over time. If somebody came to me and said, hey, I'm looking for investment, or they asked me to analyze the performance of their strategy, and their strategy took 100% winners based on the data that they were showing me, I would argue that something is wrong there. Every strategy is going to go through a period of underperformance. And the truest sign of your success, as we said right at the start of today's session, is really about how you go about managing those losing periods, right? Whether it's a single loss, whether it's a string of losses that gets you into a period of drawdown, your expectations about how you deal with that are absolutely everything. Now, if you have done this correctly and you have collected data in the right way, and you've gone about and you've understood how your strategy actually works over time, then actually your data should become the foundation for how you expect your strategy to perform, because now it gives you a baseline, right? Now it gives you some degree of a way to measure your strategy over time to determine whether things are working as they should or whether things are becoming an anomaly in alignment with your data. For example, if we took, let's say, 3 different strategies, right? One strategy over 500 trades had a 20% win rate. One strategy over the same 500 trades had a 40% win rate. And one strategy had a 60% win rate over 500 trades, right? Did you know this is not down to my opinion? This is statistical, right? This is in line with what the math is showing over time. If you've got a 20% win rate and you're looking at a sample size of 500 trades, did you know that you're likely to experience around 27 losing trades in a row? 27 losing trades in a row, right? And that's not based on you being imperfect. That's not based on you going on tilt or doing things outside of your plan. That is your strategy coded absolutely perfectly and running mechanically without your intervention, running absolutely perfectly. You're going to likely experience 27 losing trades in a row, right? If you have a 40% win rate over 500 trades, you're likely to experience around 11 losses in a row. And with a 60% win rate, which is considerably high, right, you could still go on to expect 6 losses in a row. I have lost track of the amount of traders that I have spoken to and conversated with where they have said, I'm feeling frustrated about my performance recently and I've taken, 2, 3, 4 losses in a row. And then when we actually start to break down the math of what is going on and we start looking at their win rate, we start to understand that actually your win rate has determined that you're going to lose 6, 9, 11 trades in a row over the next 500 trades, even if you are absolutely perfect, which we're human beings, we're not going to be, right? But even if you were absolutely perfect, you're still going to take a number of losses in a row. But you're getting frustrated over 2, 3, 4 losses. So for me, what's broken here is not your strategy, it's your psychology. It's the fact that you haven't fully accepted that your strategy is going to incur this amount of losses. Either it's because you didn't know and you really didn't have the data to understand how your strategy works over time, or it's because you just didn't fully accept that it would actually happen. In either case, the psychology is broken. Your mind has to be aligned to statistically what is likely to occur over time. And if it's not, then it's going to be you that ends up breaking your strategy because you're not going to cope with a period of drawdown too well. You're not going to have the mental clarity to be consistent with your approach. And ultimately, at some point in time, that's going to impact your ability to manage risk, whether that's taking trades outside of your plan and taking unnecessary risk, or risking too much in any one position, trying to chase back your losses and to make it all back as quickly as possible. instead of doing the thing that you should be doing, which is accepting this is a game of probability, keeping losses within a certain parameter that you can accept mentally and strategically, and then going on and being consistent in the long run. Okay, so some food for thought, at least from a psychological perspective, that I think most traders need to keep in mind. Most of the issues that occur when it comes to getting out of this or a period of drawdown successfully often happen because our expectations about what should occur are all flawed over time. I can see there's a couple of comments inside of, I believe from YouTube. I will come back to those towards the end of today's session. Please bear with me, and I will do my best to give you some feedback on both of those, right? We're on to the last stretch of today, which is I want to give you guys some very practical tips in terms of actually managing drawdown. Because as we've already established, and I'm hoping most of you are on board with the idea, drawdown is going to occur. It's not an if, it's a when. It's going to occur for each and every one of you. And if you take on board what we've discussed today, then you should be open to the idea that when it occurs, that is the truest test of your success. That's the test that is going to determine how well I'm going to do in this game in the long run. It's not about how much money you make. It's how much money you're able to keep. And drawdown is the first test of that period. Okay. So here are I've got 4 tips that I want to share with you guys to help you to survive or manage a period of drawdown as best as you possibly can. Tip number 1, I think for me, it all starts with acceptance. I think most people go wrong in this game and they all falter and fail and blow up and explode and lose their cool during a period of drawdown because they haven't truly accepted that it's going to happen. Now, where does that acceptance come from? Where should it come from? I would always encourage, as we recently discussed, it should come from data. It should come from an indication to say that, hey, your data is suggesting that even if you are 100% perfect, you're going to take X amount of losers in a row. You're going to statistically encounter a period of drawdown this large, and you need to be able to plan for that, both psychologically and strategically. Right? You need to make sure that you're using an amount of risk that doesn't allow you to blow up during that period. And you need a mindset that accepts that it is going to happen at some point in time. And this is why, and it's one thing that really helps to keep me from getting overconfident during good periods, because I understand the yin and yang, how everything will work. I understand my strategy has a certain win rate. And if over a short period of time, I am exceeding that win rate, I have to accept that the likelihood is, over a much larger sample size, I'm going to have losing periods which counteract that winning period and bring me back to somewhere near my statistical norm. That's what I have to expect. And so I don't get caught up in the highs because I understand there is going to be a low that balances out and brings me back to my statistical norm, right? So acceptance is a huge part in this game. From a psychological perspective, it is the thing that every single one of you needs to begin with to understand how to deal with this in the long run. The problem is most people don't accept it. Most people go into this game expecting some degree of perfection, which ultimately does not exist. The odds of drawdown occurring are absolutely guaranteed. And it's your ability to be able to manage that, plan for it, prepare for it, expect it, which is all going to determine how successful you're going to be in the long run. Okay, so step number 1 is easy. Acceptance. Understand it is going to happen, but how you respond to that situation is completely within your control. The second side to this is, I would say, if you're ever going through a period of drawdown, the first question that I would always ask myself is why, right? Why are you experiencing a period of drawdown? And I'm not saying this in a way whereby you should be questioning your approach or trying to figure out if your edge is broken. That shouldn't be the immediate thought that comes to mind. If you have enough clarity and confidence in your strategy, it should be based on a large enough sample size of data to understand that your strategy is robust enough to withstand, short periods of setbacks over time. It's only when you start creating, data outside of what you reasonably expect maybe you should start questioning the robustness of your strategy. But if it's in alignment with what you're talking about, with what your data is suggesting, then actually there shouldn't be too much that you're questioning in that short period of time. So the most important first question to ask is, why are you experiencing the period of drawdown? And really, if you have an edge in the market, there's only really going to be one of two reasons that you're going through a period of drawdown. It's either going to be one, you're doing everything correctly, but the market conditions are simply just not really aligning with how your edge works over time, right? Completely out of your control. Absolutely nothing you can really do in that situation, right? You're at a whim to the market. And like I said, after you've clicked buy or sell, you have to submit to the idea that you've relinquished control to the market, and the outcome is going to be whatever it's going to be, right? But that is possibility number one. Market conditions are simply just not in your favor. If you have a trending strategy and the markets are range bound, it's likely you're going to get chopped up. If your strategy thrives in a range bound market and the markets are absolutely tearing, like gold, for example, you're probably going to get torn up trying to pick a top or a bottom in that sort of condition, right? So is it the market conditions? Are you doing everything correctly, but just the market conditions are not really panning out in your favor? That's possibility number one. Possibility number two is actually you've gone back over your approach and you found that you're not being consistent in alignment with your plan, right? Whether it's your entry, whether it's your trade management, whether it's your exit, whether it's your risk, something in the way that you are approaching this is causing you to be inconsistent as part of your approach to the markets. And that is also a red flag. That's something that you want to be aware of, right? So if you're being inconsistent as part of your approach, you need to then understand how you're going to go about managing things going forward. What should you be doing during that space of time? And based on why you're going through a period of drawdown, for me, it makes sense to have a protocol to understand exactly how to deal with that sort of environment. For example, if you have determined that you're losing because of market conditions, they're just simply not stacked in your favor at this point in time, you've really got two options. You can either decide that you're going to scale back your risk as a means to preserving capital during these conditions which are not really suited for your edge, or you can make a decision as a retail trader that there is nothing that forces me to be in the market, right? I have no investors breathing down my back. I have no targets that I need to meet. I'm simply going to step away for a period of time, right? If you're not someone that needs a portfolio that's constantly running, that's maybe perfectly hedged to cope with all market conditions, you can decide that no position is a position and that I'm just going to sit on my hands. And this is often one that I end up utilizing. And again, I'm not saying it should be the one that you take, but it's one that you should be considering, right? If you've determined that the market conditions are simply not great, or maybe your read of the market is simply not in alignment with how it should be for any way, shape, or form, you have a choice to either scale back your risk to preserve capital over time, or to completely take a step back, step away, and understand that you can come back when the conditions have changed, right? If, for example, the only market that you traded was gold, and actually the environment that your strategy worked absolutely best in was a range-bound market, if you pull up a chart of gold, do you think it makes sense to be trying to anticipate and predict when the next range-bound market conditions are going to present? Do you not think it's likely that you're going to get chopped up in these conditions? Do you not think it's probably a far better use of your time to do something else productive instead of risking and deploying capital into the market, hoping that conditions are suddenly going to turn around and change? Now, don't get me wrong, they will, right? That's the nature of the markets. They go from expansion to contraction. And at some point in time, we will see gold top out and we'll either see it come off and retrace and we'll go into a more bearish environment, or we'll see it flatline and go range bound over time. But is it wise for you as a retail trader to actually be doing things to try and impose the market conditions that you would like when you really have no control of them? I would argue probably not, right? The second side to this is if you've gone around and you've tried to understand why you're losing and you've determined that actually you've looked over your last 10 trades and actually only 4 of them truly aligned with what your strategy says that you should be doing. You executed in the way that you should, you managed the position, and you exited all in alignment with your plan. Only 4 times out of 10, but 6 times out of 10, something was different. Maybe you cut one trade too soon because you were worried about having it turn around on you and completely U-turn, just like the last trade did. Maybe you were so worried about missing a position because 2 trades before that, you had a limit order set at a certain level in price, and price U-turned without you and it left, right? And so this time, instead of waiting for that limit order, you decided to jump the gun. You decided to FOMO into the market. And as a result of that, you still put your stop in the right place, but it completely skewed your risk to reward. Again, inconsistent approach, right? I would argue if you determine at any time that you are not implementing in alignment with your strategy, the only thing that you should be doing is stepping away from the markets. You should be stepping away to determine why is it you're not being consistent with your approach and what you should be doing going forward to help you to fix that. Whether that's just having a break, whether that's creating a little bit of space and detachment from the markets, but you need to be able to truly sit down and understand that if you are the limiting factor in your trading, how can this be fixed? If you have a somewhat mechanical approach in which you need to be the person that clicks buy or sell, and you can't code your strategy to run automatically without you, you need to figure out and you need to have a protocol of how you deal with those periods of time, right? What are you going to do to bring yourself back to what I like to call a point of emotional equilibrium? Because this is where most people go wrong. Their emotions either swing one way or the other, whether that's lacking confidence, whether that's too much confidence, and that impacts their consistency, that impacts how they manage risk, and that really is going to have a larger impact on your performance over time, right? So I would say figure out why you're losing money, figure out how you should best be managing risk during that time, and then from both of those things, go in and actually create a plan. Have a drawdown protocol at the ready that determines how you should respond to this period of time. Because the reality is, and the thing that most people don't take into an account, is that a losing streak, a period of drawdown, it costs you more than just money. That's the truth. A period of drawdown in the market costs you more than just money. Yes, there is obviously going to be financial capital at risk during that period of time, and it's going to have gone down. But the part that most people don't account for is the mental capital. How much mental capital has been expended? Because trust me, when your mental capital runs down to zero and you don't have an ability to think and act clearly in terms of how you approach the markets, this is going to have an impact on your performance. And if you don't have that cool, calm, and stable mind to stick to your plan and to work yourself back out of drawdown, that is going to have a huge impact on everything that you do going forward. So I would argue that you need a drawdown protocol that addresses 2 separate areas of how you approach the markets. The first one is strategic, right? Much like we talked about, judge the market by the conditions that you're currently experiencing. Maybe you're finding that market conditions are a lot more volatile during this period of time. And maybe my stop losses or my targets need to be adjusted to account for this higher amount of volatility. Normally, I have a very mechanical plan that says when I get in here, I can use a 20-point stop on every single one of the trades that I take. Actually, if volatility is higher, maybe it makes sense to adjust that in alignment with the market conditions that are presenting. Again, just one way in which you can look at the strategic element of your approach, and you could say that actually by adapting to what I'm doing to certain market conditions, it could actually help me to improve my odds of making money during this time, but only if it does not break your edge, right? Again, you want the data. You want to be able to understand that this is something that actually works for you over time. So if you're thinking about making any sort of strategic change, especially when it comes to how you approach the market or how you're analyzing the market in any way, shape, or form, make sure it's backed by data. Don't do it based on a gut feeling because of the thoughts and the emotions that you're experiencing at the time. Make every decision in the markets a strategic one based on data, based on something that's objective, not necessarily subjective. Because, and the question that I always go back to is, if you have a fairly subjective approach to the market, if you have a discretionary approach, how do you know you have an edge? Because if you can't answer that clearly, how are you going to have the confidence to stick to it when you've taken 2, 3, 4, 5, 10 losing trades in a row? The reality is most people won't. Your psychology will kill you before your account runs down to zero. And that's what's probably going to accelerate that rate down to zero at some point in time, right? So that's from a strategic perspective. The second side to this is the psychological one. Expect and anticipate that at some point in time, if you're going through back-to-back losses, it's going to have an impact on you, right? It's going to weigh down on you and you're going to feel a certain level of stress, whether that's the stress of not making any money, whether that's the stress of not performing to the standard at which you would like to stick with over time. It's going to be something that decision by decision, outcome by outcome, it drains your mental capital one trade at a time. And if you don't have a plan of how to go out and how to deal with that stress, again, it's going to be something that works against you. So I would say have a drawdown protocol that deals with the strategic element in terms of if and how you want to change anything in terms of your approach, whether that's the actual approach itself, whether that's just the risk management, and you want something that deals with the psychological impact of a period of drawdown. How are you going to deal with stress? Do you need to be spending more time outside touching grass? Do you need to be going to the gym more? Do you need to be meditating? Do you need to be journaling? Do you need to be, doing some form of exercise to keep your mind busy and to have that chemical dopamine release inside, have those good endorphins running through your body? These are all things that you need to be considering, but they don't work unless you have done the needful at the very beginning, which is accepted that is going to occur. One of the biggest reasons I see most traders failing in this game is largely because they have a plan that tells them when to get into the markets and how to make money, but they have no plan that tells them when they should be staying out and how to manage their risk when nothing is going their way. The moment you can develop a plan that does both of those things, you're onto something good, right? I always have this quote that I share with many of my clients, and it's this idea that a good plan tells you when to get into the market. A great plan tells you when to stay out, right? And it's something that we should actively be thinking about here when it comes to measuring our performance over time, okay? That is all for today's topic, right? I hope that's been of value to you. I hope it's given you something to think about in terms of analyzing your performance over time and developing, like I said, these kind of drawdown protocols to deal with them when they inevitably occur, because absolutely guaranteed they are going to happen for each one of you over time, okay? The couple of questions that I wanted to come back to. Rabi says, I use statistical arbitrage strategies using bots. Can I use them on Darwinex 0? Can you answer me this after you finish your speech? Rabi, if I'm being completely honest, I'm not 100% sure. If Kieran's around in the background, maybe that could be one that he could pick up on and answer for you specifically. I don't want to give you any wrong advice here, but it is something I could definitely check and get back to you over time. But yeah, not 100% on that one. Apologies, I couldn't be of more help at this point in time. Vic says, how many trades should be made with the same strategy before you determine whether it's worth continuing to use? Vic, that's a great question. The reality that I find is that there is no one specific number that is going to determine that something either works or doesn't work, right? It's completely possible that we are about to enter some form of market conditions which we have never experienced before. And so even if you've been through thousands of examples and decades worth of data, it's not going to prepare you for the conditions that are about to arise. You have to remember that everything in this game is largely about probability. And when we're talking about probability, we have to get rid of the idea of seeking certainty. So whilst I can't give you a black and white number as to what is going to be the best point that you should continue using the strategy, or whether you should determine that it just doesn't work, there are some kind of guidelines which I often recommend, right? And for me, the starting guideline before you determine anything should be at least a minimum of 100 trades and at least 1 to 2 years worth of data. Now, again, this is going to vary. And I like to use those two criteria rather than just the one, largely because it helps to find probability over time, right? If you're a short-term scalper, finding 100 trades in the market could happen in a month, but it doesn't account for the differences in market conditions over time. By sticking to at least 1 to 2 years worth of data and at least a minimum sample size of 100, I think you're doing yourself a favor in figuring out what is probability and what is just randomness, and what are somewhat normal market conditions for me, and what are erratic ones that maybe it doesn't work so well in. So use those as a benchmark to begin with, but don't let them be the upper end of where you're working with. I would always say, start to think in hundreds and thousands when it comes to sample sizes of data, and start to think in years and decades when it comes to periods of time. If you're sitting here and you're saying, well, actually, I've tested 30 trades over the last 4 months and I've gained 25% of my account, fantastic, but it's not necessarily indicative of an edge, right? So unfortunately, I wish I could have, this magical number or sample size that will tell you this is going to be the baseline that you need to determine if something works or not. The reality is it's a game of probability, right? I would just, the words of advice that I would give you is to understand that the more you have, the better. But there's never really any guarantee over time, right? Is it possible that your edge can decay over time? 100%. But this is why I think the mindset of a trader always has to be geared towards the idea that this is a game of constant improvement and tweaking and data collection and journaling and testing over time. Because I can guarantee you one thing, market conditions are always going to be different. The participants that are taking and are getting involved in the market today are going to be different to the ones tomorrow. And that means we have to be willing to adapt over time. And if we can't do that, then unfortunately, at some point in time, it is likely that your edge is not going to work the same way in which it did maybe a decade ago. That is, again, it's not guaranteed, but there's a possibility of it happening. So Vic, I hope that gives you some idea of kind of where I'm going with this. Again, thinking hundreds and thousands in terms of trade examples, and thinking years and decades when it comes to sample sizes of time. Okay, hope that helps. If there is anybody else that has any questions, just to remind you, I always like to try and leave a few minutes of Q&A towards the end. So if you do have any questions, please feel free to throw them inside the chat, and I will happily address them. I'll stay on the line for about 30 seconds or so, but if there is nothing, I will wind down today's session and allow you guys to go about enjoying the rest of your day. In the meantime, again, as I mentioned, I hope you guys have enjoyed the content of today. The purpose of everything that we are doing here is really about creating some thought, some provoking ideas, and to get you to understand about what you need, the aspects in which you need to be thinking to really give you that consistency, both in terms of your approach and both in terms of how you manage risk over time. So if today has done that for you, if it's got you thinking about one area of your performance in some way, shape, or form, then it's done its job, right? I can't see any more comments, so we're going to wind down today's session. Thank you all so much for your time. Thank you to the team at Darwinex for allowing me to host another fantastic session for you guys again. I look forward to catching up with you in another couple of weeks, and I hope you have a fantastic trade performance in the meantime. Thank you guys so much. Take care.